Welcome to the April Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, the Dow reached record territory in March, with some economists stating that valuations seem reasonable, all things considered. What should investors with cash on the sidelines consider doing in this environment?
The key phrase there is all things considered. We are in an unusual economic environment, as everybody knows, and one of the interesting things about current stock valuations are, given current interest rates, given the situation, indeed they do seem reasonable. On a historical basis or a longer term basis, valuations seem stretched. So the question when you're looking at what to do with money right now really devolves into another question, which is, are you more concerned about missing additional run-up going forward, or are you more concerned about downside risk? A lot of people are calling for a short-term pullback. We don't know. If we knew, it would be easy, and we don't know. So the question really is, how much risk are you willing to take in the short term? Now, I would personally argue that one way to look at it would be to look at a dollar cost averaging strategy. If you had enough money to put in right now, you could put in, say, a quarter of it every 3 months over the next year. That gets you into the market, that allows you to participate on the upside, but at the same time it limits your downside participation. If your risk perception is different, obviously you might want to do something different, but that's one way to go.
Well, Cyprus emerged as the latest European economy to falter, resulting in cries from Russia for a speedy recovery to their banking woes. What is the connection between those two countries, and how concerned should we be about this?
Cyprus was, I think, a surprise to everyone. Not in that it happened, which for anybody who was looking was not a surprise, but in the way it was resolved. And the problem is this: Cyprus's banking system is much, much larger than the economy of the country. There is no way the country can rescue the banking system. Second of all, Cyprus's banking system is largely financed by deposits, so they couldn't wipe out the equity holders and the bond holders as a way to finance the bailout. The problem is a lot of the depositors come from Russia, and there is a perception that a lot of that is tax evasion money, shady money, money laundering money, and because of that, the notion of bailing out the depositors with typical deposit insurance, which is what people would have expected to happen, was a very, very tough sell politically to the northern economies, which would have been writing the check. Because of that, they balked and said, no, depositors have to take a hit, including small depositors. This was, in my opinion, a huge mistake, as it really calls into question the Euro's commitment to the general population and to their banking system. The problem is not Cyprus itself, because it's too small to matter. The problem is what this means for the banking system across the Eurozone, and in particular in the already troubled peripheral countries such as Spain and Italy.
Back home, the housing market continues to recover, bolstering jobs in construction. How is the job market doing overall, and are other sectors showing signs of sustained recovery?
The job market is coming back in an increasingly strong fashion. We've seen job growth continue to grow. We've seen revisions in past data. I've actually been quite pleased with the way the job market is continuing to shape. And we're starting to see some signs that the housing recovery is starting to feed through into other sectors. We're seeing employment in housing, as you say, go up, housing construction, but also in financial services related to housing, also in manufacturing for items like carpets and so forth that go into new homes. So we're starting to see a broad-based recovery, and housing is indeed spreading to other sectors. And I think that's going to be a really good sign going forward. I see the employment recovery continuing to be strong.
Did anything surprise you in the first quarter, and what are you looking forward to next quarter?
I think the biggest surprise, and for a change it's a pleasant one, is the continuing strength, and indeed the strengthening strength, if I can use that phrase, of the housing economy and the economy as a whole. Despite all of the hits that we took at the start of the year, the tax increase, the uncertainty associated with the tax increase, consumer spending has continued to increase, wage growth continues, jobs continue, housing is getting even better as we go. We're really well positioned from a real economy point of view to really continue to do well in the second quarter. That said, we've had this in the past couple of years where the first quarter was quite strong, the second quarter not so much. That's certainly a possibility. But I think the signs are quite good at this point.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.